James, how did the Harmony portfolios fare in November?
Well, November was very much a month of two halves, really. It started quite poorly in the build-up to the elections and then rallied pretty heavily, almost equal and opposite, in fact, towards the month end. Overall, global equities up 1.3%, but the swings up and down were in the order of, not far off 5% both ways over the month. So it was, an interesting period, really. All of the funds provided positive absolute returns, which is, clearly what we'd always like to do every month. We've had a nice run, actually, of positive absolute returns in these markets, and that's been reflected in the Harmony funds over the last few months. Interesting performance differentials between the different regions. So Europe ex-UK was the strongest, returning nearly 3% in euro terms. Asia ex-Japan next strongest, returning over 2%. And the laggards, Australia and the US. We've been a little bit worried about the US for a while. It had performed a lot better than the other regions over the last 12 months or so. And Australia and the US both returned less than 1% in the month. So there were some pretty significant regional deviations. Other markets, global government bonds, they didn't do a huge amount, to be honest, not particularly impactful on the returns either way. And high yield, while positive, wasn't quite as strong as we would hope in months where the equity market was up over 100 basis points, but nevertheless, still a positive influence on returns.
You've spoken about regional variations there. How about, say, sectors? Did anything, come to the fore effectively?
Well, consumer discretionary is an area where we've seen some pretty significant grinds up in valuations over a number of months, and the Harmony range has done well from that. Is holding in Morgan Stanley Global Brands is designed to be very much keyed into that part of the market. Interestingly, consumer discretionary as opposed to consumer staples actually did well this month, and IT was probably globally the best performing sector out there. As far as countries go, Japan was by far and away the strongest returning nation states equity market in that period.
Interesting. Did you or the team elect to make any significant changes last month?
Our asset allocation and manager selection policy is still very much an evolutionary one. Over the last couple of months, we've sort of moved things, but we haven't made material changes to the portfolios. One of the largest underweights we've had for a couple of months has been the underweight property securities, 3% underweight there. We've had that position on a valuation basis. Property securities were a bit expensive compared to the rest of the equity market, and so we decided to wind that position to underweight. We are adding now, literally as we speak, infrastructure securities into the portfolios. They have similar characteristics to property, but they have some which we also think are more favourable, and valuations which are more on side than the real estate securities market. So infrastructure securities generally have well-capitalised, high-quality businesses with monopolistic sort of control over their particular infrastructure, highly predictable cash flows as far as one can in equity markets, and particularly they have the ability often to either link their revenue streams to inflation or another price cost type of model, and that's generally protected by the local government or the sovereign state in that particular area. So it's got some interesting characteristics. Elsewhere, we remain heavily underweight government bonds. We think they're still very expensive, and every month that goes by and they continue to just grind up, a bit like November, in fact, quite in many of the markets, just adds to our conviction that being underweight government bonds is the right thing to do. And we're overweight many different parts of the credit market, investment grade, high yield, although we've started cutting that position back now, and likewise convertible bonds, where we were more heavily overweight than we are today.
Thank you, James. And finally, looking forward to 2013, first quarter, first half, what are you seeing?
Well, I think before we get to 2013, we've got the not insignificant issue of the fiscal cliff to overcome. we're very much of the view that it will be resolved, but it will be resolved at the 11th hour, just as the cliff is due, if you like. In the meantime, we expect a lot of political horse trading around it. But it's interesting that even in the last few days, the rhetoric between the Republicans and the Democrats has started softening, and both sides are starting to show a willingness to accept each other's stance to start moving to a more centralist position. We think that will get sorted, but the other interesting thing to bear in mind is GDP generally in the developed world. Analysts' forecasts of GDP looking into next year have already started to be written down a number of months ago, and they're a lot less aggressive than the levels we saw at the start of this year, the start of 2012. So analysts' forecast of GDP in the US is something in the order of 2% growth, still a positive growth number. And although it's quite easy to find a reasonably negative story there, it's not a big number, it's something to worry about. Actually, I'm of the view that what it does do is it means that we're less likely to be disappointed by GDP next year on the downside, by coming in with a greater degree of circumspection than perhaps we had over the last couple of years, where analysts started the year far too buoyantly, only to be disappointed. I think 2013 might start with a more reasonable kind of return outlook or GDP growth outlook, and that actually might reduce, hopefully, some of the volatility in the early months that we've seen over the last 2 years.
Excellent. James, thank you very much.
Thanks, Richard.